Legal battle threatens Shell's $1 billion South Africa fuel exit, 10% of petrol market at stake. A high-stakes legal dispute is casting uncertainty over Shell's planned $1 billion exit from South Africa's fuel market, where the energy giant holds a significant 10% share of the petrol sector. The contentious issue revolves around Shell's downstream business, Shell Downstream South Africa, SDSA, and a fallout with its long-standing Black Economic Empowerment (BEE) partner, Thebe Investment Corporation. This conflict, combined with a recent decision by Swiss energy firm Gunvor to sever ties with its local BEE partner, AfriFund Investments, has sparked a legal showdown that could reshape South Africa's fuel industry. Background: Shell's long history in South Africa. Shell has been a fixture in South Africa's energy landscape for over 120 years, operating approximately 591 petrol stations and related downstream assets. These assets, which include fuel distribution networks and forecourts, account for a substantial portion of the country's retail fuel market. In early 2024, Shell announced its intention to divest its shareholdings in SDSA, signaling a strategic retreat from South Africa's downstream operations. The decision followed a global portfolio review, with Shell citing a need to focus on higher growth markets and cleaner energy ventures. However, the divestment process has been anything but smooth. Reports of a dispute with Thebe Investment Corporation, Shell's BE partner, surfaced in May 2024, with sources indicating an acrimonious business fallout. This disagreement has now escalated into a legal battle that threatens to derail the sale of Shell's assets, valued at approximately $1 billion. The Gunvor AfriFund fallout. Adding complexity to the situation is a parallel dispute involving Gunvor, a Swiss-based energy trading firm that was poised to acquire Shell's downstream assets. On May 26, 2025, reports emerged that Gunvor had abruptly terminated its partnership with AfriFund Investments, a local BE firm led by businessman Sipho Masiko. AfriFund was intended to serve as Gunvor's local empowerment partner, a critical requirement under South Africa's BE regulations, which mandate that foreign companies partner with local entities to promote economic inclusion. The decision to dump AfriFund has triggered significant backlash, with Masiko and his team reportedly preparing legal action to challenge Gunvor's move. The fallout raises questions about the compliance of any potential deal with South Africa's stringent BE laws, which could further complicate Shell's exit strategy. Without a credible BEE partner, Gunvor's bid to acquire Shell's assets may face regulatory hurdles, potentially delaying or even derailing the transaction. Economic and market implications. Shell's downstream operations are a cornerstone of South Africa's fuel market, servicing roughly 10% of the country's petrol demand. The uncertainty surrounding the divestment has raised concerns among industry stakeholders, as the outcome could impact fuel supply chains, retail pricing, and market competition. South Africa's fuel sector is already navigating challenges, including volatile global oil prices and a looming natural gas shortage projected for 2026. Recent data highlights the delicate balance in South Africa's fuel market. Petrol prices have seen modest relief in 2025, with 93 unleaded dropping to our 21.29 per litre and 95 unleaded to our 21.40 per litre as of May 7, 2025, driven by lower global crude oil prices. However, an anticipated increase in fuel levies effective June 4, 2025, could offset these gains, adding pressure to consumers and businesses alike. The potential disruption caused by Shell's exit could exacerbate these pressures, particularly if the legal disputes delay the transfer of assets to a new operator. Broader context. South Africa's evolving energy landscape. Shell's planned exit comes at a pivotal moment for South Africa's energy sector. The country recently launched the South African National Petroleum Company, SANPC, a state-owned entity formed by merging PetroSA, iGas, and the Strategic Fuel Fund. SANPC aims to bolster South Africa's hydrocarbons sector and reduce reliance on energy imports amid a deepening power crisis. Meanwhile, other global players like TotalEnergies and Qatar Energy are investing in high-risk offshore exploration, signaling continued interest in South Africa's oil and gas potential. However, Shell's divestment reflects a broader trend among multinational oil companies re-evaluating their presence in South Africa. The combination of regulatory complexities, such as BEE requirements, and the global shift toward renewable energy may be prompting firms like Shell to redirect capital elsewhere. The outcome of the legal battles involving Thebe Investment Corporation and AfriFund will likely set a precedent for how such exits are managed in the future. What's next? As the legal disputes unfold, all eyes are on Shell, Gunvor, and their respective BE partners. Thebe Investment Corporation's grievances with Shell remain undisclosed in detail, but the fallout suggests tensions over the terms of the divestment or the valuation of assets. Similarly, AfriFund's legal challenge against Gunvor could hinge on contractual obligations or allegations of unfair treatment under BE frameworks. For South African consumers and businesses, the stakes are high. A prolonged legal battle could disrupt fuel supply chains, affect pricing, and create uncertainty in a market already grappling with economic pressures. Industry analysts are closely monitoring the situation, as the resolution will not only determine the fate of Shell's $1 billion asset portfolio, but also signal how South Africa navigates the intersection of global energy transitions and local empowerment policies. In the meantime, Shell's iconic branding, a mainstay at South African petrol stations for over a century, may soon disappear from the landscape, marking the end of an era. Whether this transition ushers in new opportunities or further challenges for South Africa's fuel market remains to be seen.